SoFi Technologies is trading at $26.18, down a significant $2.27, which is a drop of 7.96% in today's session. Now, on a day like this, the immediate reaction for many is to look for a single piece of bad news, a downgrade, a negative press release. The expectation is that a company with this much positive sentiment behind it only falls this hard on a specific, identifiable catalyst. But the reality of what's happening with SoFi today is far more complex and speaks to a deeper tension in the market for high-growth fintech names. This isn't just about one news item. It's about a confluence of factors that are challenging the prevailing narrative that has propelled the stock for months. The story most investors, particularly those using platforms like the Robinhood app or even SoFi's own SoFi Invest platform, have bought into is one of a disruptive force in finance, a one-stop shop that will redefine personal banking for a new generation. They see the sleek interface, the Super Bowl stadium, and the constant member growth as signs of an inevitable ascent. The reality we're seeing play out on the charts today, however, is that SoFi is still subject to the old-school rules of market mechanics, valuation concerns, and investor psychology that have nothing to do with how good its app is. What we are likely witnessing is the consequence of a lockup period expiration. For those unfamiliar, after a company goes public, typically via a SPAC, as SoFi did, early investors and insiders are locked up, meaning they cannot sell their shares for a predetermined period. When that period ends, a large supply of shares can suddenly become available to be sold on the open market. This doesn't necessarily mean the company's fundamentals have changed, but it creates immense selling pressure. The expectation is that everyone is a long-term believer. The reality is that early venture capital and private equity investors have a fiduciary duty to return capital to their own partners, and they will take profits when they can. Today's high trading volume confirms this. We're seeing volumes far exceeding the daily average, suggesting that large blocks of shares are being moved. This isn't your typical retail investor selling a few shares through their Fidelity mobile app. This is institutional level distribution. This pressure forces market makers to lower their bids to absorb the supply, causing the price to cascade downwards. This is a critical lesson for anyone engaged in online investing. The story of a company and the technical supply and demand dynamics of its stock are two different things, and today the latter is in complete control. This sell-off is happening within a broader, more hostile macroeconomic environment for companies like SoFi. The Federal Reserve has made its intentions clear regarding interest rates. For a growth company that is not yet consistently profitable in GAAP terms, its valuation is heavily dependent on future earnings. When you raise interest rates, the discount rate used to value those future cash flows goes up, making them worth less in today's dollars. This is a concept that sophisticated clients of Fidelity Wealth Management or traders using interactive brokers are keenly aware of, and it's causing a major rotation out of high multiple growth stocks and into value-oriented, profitable companies. The expectation was that SoFi's growth story was so compelling it could defy gravity. The reality is that it's caught in the same gravitational pull as every other growth stock right now. Its innovative business model doesn't make it immune to fundamental valuation principles. Whether you're building a Schwab Intelligent Portfolios allocation or actively trading Nvidia stock, this market-wide theme is impacting your decisions. The fintech sector in particular is feeling this heat. Investors are becoming more discerning, asking harder questions about the path to profitability for companies that have long been given a pass as long as user growth was strong. Let's dissect the business itself for a moment, because the long-term thesis hasn't necessarily been invalidated by today's price action. SoFi operates through three main segments. First is lending, their legacy business, which includes student loan refinancing, personal loans, and home mortgages. The student loan business has been hampered by the federal payment moratorium, but the eventual return of this high-margin activity remains a significant potential catalyst. Second is their technology platform, centered around Galileo, which provides the back-end infrastructure for many other fintech companies and financial institutions. This is a crucial B2B element that many retail investors overlook. It provides a diversified, high-growth revenue stream. And third is financial services, the part of the business most people know. This includes SoFi Money, a cash management account, SoFi stocks and ETFs through SoFi Investing, a credit card, and other products. Their core strategy is the financial services productivity loop. Acquire members at a low cost through one product and then successfully cross-sell them higher-margin products over time. The most important recent development was securing a national bank charter. This is not just a regulatory footnote, it's a profound shift in their business model. It allows them to use their own member deposits to fund their loans, drastically lowering their cost of capital, compared to relying on third-party banks. This directly impacts their net interest margin and is the clearest path towards sustained profitability. Many people managing their individual brokerage account saw this as the ultimate green light. So, how do we reconcile the strength of that business model with the brutal reality of a near 8% drop today? This is the core challenge of self-investing. You have to be able to hold two opposing ideas at once. The company's long-term potential can be intact, while its short-term stock performance is terrible. The market is not always a reflection of a company's current operational success. It is a forward-looking and often fickle pricing mechanism. Right now, it's pricing in the risk of insider selling and the risk of a higher rate environment. It's not necessarily pricing in the full long-term benefits of the bank charter or the eventual return of student loan refinancing. This creates the tension between expectation and reality. The expectation from the bulls is that the bank charter and member growth make the stock a surefire bet. The reality is that the market is currently prioritizing macroeconomic fears and technical selling pressure over that long-term narrative. This is where opportunity and risk live side by side. For an investor using a platform like Fidelity or Interactive Brokers, the question becomes whether this sell-off is a chance to initiate or add to a position at a better price, or if it's a warning sign of further downside to come. Looking forward, the path for SoFi stock is dependent on a few key factors. First, how quickly can the market absorb this new float of shares from the lockup expiration? We need to see selling volume begin to taper off and the price find a level of support. This could take days or even weeks. Second is their next earnings report. The company must continue to demonstrate strong member growth, growth in product adoption, and, most critically, show tangible progress on how the bank charter is improving their margins and bottom line. Any sign of a slowdown would be punished severely in this market. The narrative has to be backed by numbers. Third is the macro picture. An unexpected dovish pivot from the Fed could relight a fire under growth stocks like SoFi, while a more aggressive stance could continue to suppress its valuation regardless of how well the company executes. And finally, there's the student loan moratorium. The moment the federal government gives a definitive end date, it will serve as a massive catalyst, allowing their largest and most profitable lending vertical to get back to business. Comment below what you believe is the single biggest factor for SoFi's stock price over the next 6 months: earnings execution or the Fed's interest rate policy. It's a debate that many investors are having right now, from those with basic Robinhood investments to those with complex portfolios. In conclusion, today's sharp decline in SoFi stock is a classic case of reality clashing with a powerful market narrative. The expectation was a smooth upward trajectory for a premier fintech disruptor. The reality is a potent cocktail of technical selling pressure from a lockup expiration and a punishing macroeconomic backdrop for growth stocks. The fundamental story, underpinned by the new bank charter and a strong product ecosystem, hasn't changed, but the market's market's willingness to pay a premium for that story has, at least for now, changed. Understanding this distinction is what separates reactive trading from strategic investment. The immediate pain in the stock price is real, but it's driven by forces that are, in many ways, external to the company's day-to-day operations. The ultimate test will be whether SoFi's business execution can eventually outweigh the market's current fears. That's the dynamic that will determine its future, and it's a far more nuanced picture than today's brutal price action suggests. The content shared on this channel is for educational and informational purposes only. It should not be considered as financial, investment, or legal advice. Always do your own research or consult a qualified financial advisor before making any investment decisions. If you found this video helpful, don't forget to like, comment, and share, and subscribe for more finance insights. Grab it!